All right, let's jump right in. You've got that bonus, maybe burning a hole in your digital pocket.
Happens all the time.
And that age-old question pops up, right? Do I shield it away, save it, or try to make it, well, multiply, grow?
Yeah, it's that classic financial fork in the road. We all face it.
And today we're going to try and navigate it, give you some clarity.
Exactly. At the heart of it, we're looking at two fundamental ways to handle your money.
Okay.
Building that secure base, through saving, and then aiming for long-term expansion through investing.
Like defense versus offense for your finances.
That's a great way to put it, yeah.
Defense and offense.
And our goal, our mission in this deep dive, is to really get under the hood of both. We're not just skimming the surface here. We want to understand the mechanics, the pros, the cons, the potential pitfalls.
So that you, the listener, can build a strategy that actually works for you.
Because everyone's situation is different, isn't it?
Totally unique. What works for one person might be, well, completely wrong for another. Okay, so let's start with the essentials then. Saving. What does it actually mean to save?
Right. Saving, at its core, it's really about setting aside funds you don't need right this second.
Keeping them safe.
Keeping them safe. Keeping them easy to get to for when you do need them. It's your immediate financial cushion.
Typically in accounts with like minimal risk, yeah.
Minimal risk, exactly. And there are a few common places you'll see savings parked.
Like your standard bank savings account.
Yep, your standard savings accounts. They're highly liquid. You can get your money out easily. But the interest they offer is usually, well, pretty modest.
Okay. Modest returns, easy access. What else?
Then you have certificates of deposit.
CDs.
Ah, yes, CDs. These often give you a slightly better interest rate. The catch.
There's always a catch.
Your money is locked in for a specific amount of time, a set term.
So you're trading some of that immediate access for maybe a bit more interest.
Exactly. And you need to watch out for penalties if you pull the money out early. That's key.
Good point. Okay, what about money market accounts?
Money market accounts. They're kind of a hybrid. They often offer interest rates a bit better than regular savings.
Okay.
And they still keep things pretty liquid, relatively easy access.
What?
But their interest rates can fluctuate more. They aren't usually fixed like a CD rate might be.
Got it. So those are the main vehicles, savings accounts, CDs, money markets. Why is savings so valuable even if the returns aren't, huge?
It comes down to three main things: accessibility, safety, and predictability.
Okay.
Having cash ready for emergencies or for goals that are just around the corner, that's vital.
Opposite of mind, really.
Huge peace of mind. And with things like FDIC insurance protecting many of these accounts, the risk to your actual money, your principal, is very, very low.
And the returns, while low, are stable.
Generally stable, yeah. You pretty much know what you're going to get, even if it's not a lot. Predictable.
Makes total sense. It's that financial security blanket we all need. But what's the downside? What are we potentially giving up by keeping too much cash sitting in savings?
Well, the big challenge, honestly, is inflation.
The silent wealth killer.
Right. The returns you get often just don't keep up with the rising cost of living.
So your money actually buys less over time.
Exactly. The purchasing power erodes.
No.
And there's also opportunity cost.
Meaning
that money, if it were invested somewhere else, could potentially be growing much, much faster over the long run. You're missing out on potential growth.
Okay, let's unpack this then. Saving, security, access, predictability, cons, low returns, inflation risk, opportunity cost. Got it.
Now investing.
Right. Let's shift gears. How is investing fundamentally different from just putting money aside?
Investing is about allocating your money, putting it into assets, things like stocks or property, with the expectation that those assets will go up in value or generate income over time.
So you're putting your money to work hoping for a return.
Precisely. You're taking on some risk with the hope of getting a better return than saving typically offers.
And just like saving, there isn't just one way to invest, right? There are different options.
Oh, absolutely. A whole range. You've got stocks, for instance.
Buying shares in a company.
Yep. You own a tiny piece of that company. Yeah. Huge potential for growth. Maybe some income through dividends, too.
Dividends being a share of the profits.
Right. But, and this is a big but, stock prices can swing wildly. Volatility.
Okay. Stocks. What else?
Bonds. These are basically loans. You're lending money to a government or a company.
And they pay you interest for that loan.
Correct. A fixed interest rate, usually over a set period, generally seen as less risky than stocks.
But probably lower potential returns, too.
Typically, yes. Lower risk often means lower potential reward.
Makes sense. What about things like mutual funds or ETFs? I hear those terms a lot.
Good question.
Right.
Mutual funds and exchange-traded funds, ETFs, they pool money from lots of people.
Okay.
And professional managers invest that pool of money into a whole basket of different things, stocks, bonds, maybe other assets. It's instant diversification.
So you don't have to pick individual stocks yourself.
Exactly. But you do need to look at the fees, the expense ratio, because that eats into your returns over time.
Right. Fees matter. And real estate. Can't forget that.
Definitely not.
Right.
Buying property, hoping it appreciates, or maybe renting it out for income.
That feels like a big one. Lots of other factors there.
Oh, yeah. Liquidity can be an issue. Selling property takes time, and maintenance costs, tenants. It's a different ballgame.
Okay. So quite a few options. Why take on the extra complexity, the extra risk of investing? What are the big draws?
Well, the number one reason is the potential for significantly higher returns, especially over the long haul.
Beating inflation, maybe?
Hopefully, yes. And then there's the magic of compound growth.
The snowball effect.
Exactly. Your earnings start generating their own earnings. It's incredibly powerful over decades. You know, earning 10% one year, then the next year you're earning 10% on the original plus that first 10%. It really adds up.
It's like interest on your interest.
That's it. And finally, diversification, which we mentioned with funds. Spreading your money around helps manage risk. Don't put all your eggs in one basket, right?
Right. So higher potential returns, compounding, diversification sounds like the path to building wealth, but there have to be downsides, potential pitfalls.
Oh, absolutely. Here's where it gets really interesting, or maybe a bit scary, depending on your perspective.
Uh-oh. What are the main risks?
With greater reward potential comes greater risk. That's the fundamental trade-off. Market risk is the big one.
Meaning the value of your investments can go down.
Absolutely. Sometimes sharply. You could lose money. There's no guarantee of positive returns, especially in the short term.
Okay, that's crucial to understand. What else?
Well, it's more complex, isn't it? Understanding different investments, markets, the economy. And it takes research, ongoing learning, really.
It's not just set it and forget it's like maybe a savings account is?
Not entirely, no. And finally, liquidity. Some investments aren't easy to turn back into cash quickly if you suddenly need the money. Think real estate again, or maybe certain types of funds.
Okay, so investing. Potential for big growth, compounding is great, but real risk of loss, it takes more effort and knowledge, and your money might be tied up.
That sums it up pretty well. Big differences from saving.
Definitely. So we understand saving, we understand investing. The big question now is, when do you do which? Or is it both?
It's usually both, but the balance is key. And that balance depends on you.
Me, the listener.
Yes, you. It boils down to your specific financial goals, how soon you need the money, that's your time horizon, and how comfortable you are with seeing your investment values bounce around, your risk tolerance.
Okay, let's break that down. When is saving definitely the right move?
Saving is generally your go-to for short-term goals.
Like a vacation next year.
Exactly. Vacation, saving for a car, down payment in a couple of years, maybe wedding expenses, holiday spending, things you know are coming up soon.
And the big one.
The emergency fund. Absolutely critical. That safety net of 3 to 6 months worth of essential living expenses.
You keep mentioning that. It's really foundational.
It absolutely is. It provides that buffer against job loss, unexpected medical bills.
Yeah.
Massive peace of mind. It lets you invest without panicking when life happens.
Makes sense. And also for people who just really hate risk.
Yes, if you're very risk averse, if preserving your capital is the absolute top priority, saving will likely make up a larger slice of your financial pie.
Okay. Short-term goals, emergencies, low risk tolerance, lean towards saving.
Pretty much. Now, when does investing make more sense?
Logically, it seems like it's for the longer-term stuff, right? Retirement way down the road, kids' education fund.
That's exactly right. Long-term goals, retirement, education funding decades away, or just generally building significant wealth over many years.
Because you have time to ride out the market ups and downs.
Precisely. With a longer time horizon, you have more opportunity to potentially recover from market dips and benefit from those higher average historical returns we talked about.
And the inflation thing again.
Yes. Investing is potentially your best hedge against inflation over the long run. The goal is for your returns to outpace the rising cost of living, which saving struggles to do.
Okay. And if you're okay with a bit more risk?
If you have a higher tolerance for that market volatility, if you're willing to accept some bumps in the road for potentially greater long-term gains, then investing is likely going to be a major part of your strategy.
So thinking about your goals, listener, where does your current focus lie? Near-term safety or long-term growth? Maybe a bit of both.
And that's usually the answer, isn't it? A bit of both. A truly robust financial strategy isn't really an either. It weaves saving and investing together.
They complement each other.
They really do.
Okay, so how do we actually build this balanced approach? What are the steps? Where do you start?
If we connect this to the bigger picture, the very first step, almost always, is that emergency fund.
Build the foundation first.
Get that security blanket in place. Priority number one. Once that's solid,
Then what?
then you really want to attack any high-interest debt. Credit cards, payday loans, that stuff.
Oh, yeah. The interest rates on those are brutal. They'll kill any progress you make elsewhere.
They absolutely will. Paying, say, 20% interest on a credit card while trying to earn 8% investing, it's a losing battle. Get rid of that high-cost debt.
Okay. Emergency fund done. High interest debt tackled. Next.
Define your goals. Get really clear. What are you saving for? What are you investing for? Short-term, long-term. How much do you need? By when?
Having clear targets makes planning easier.
Much easier. Then you need that honest self-assessment. What's your risk tolerance? How much volatility can you really stomach without panicking and making bad decisions?
That's so personal, isn't it? Like you said, someone retiring in 30 years feels different than someone needing a down payment next year.
Massively different. And understanding your tolerance is key to sticking with your investment plan when markets get choppy.
Okay, goals defined, risk tolerance assessed. Now what? Choose investments. Now you think about diversification within your investments. Don't put everything in one stock or one sector. Spread it out across asset classes, stocks, bonds, maybe real estate, maybe international.
Spreading the risk.
Exactly. And finally, and this is crucial, this isn't a one-time thing. You need to regularly review and adjust.
Life changes, markets change.
Your goals might change. So look at your plan periodically, maybe once a year, or if something big happens in your life, and make adjustments as needed. Keep it aligned with where you are and where you want to go.
So it's a dynamic process. Emergency fund, debt, goals, risk, diversify, review, adjust.
That's a pretty solid framework.
Can we make this even more concrete? Maybe walk through an example.
Practical scenario definitely helps. Let's think about
Sarah. Okay, Sarah, what's her situation?
Sarah has two main goals right now. First, she wants to buy her first home maybe in about 3 years.
Okay, short-term goal.
Right. Second, she's also planning for retirement, but that's like 30 years away.
Long-term goal. Okay, two different timelines. Exactly. So for the house down payment, that 3-year goal, she's prioritizing saving, putting money into a high-yield savings account.
Makes sense. Needs it safe, needs it accessible relatively soon, low risk.
Precisely. But for retirement, that 30-year horizon, she's taking a completely different tack. Investing. She's putting money into a diversified portfolio mix of stocks, bonds. She's okay with the ups and downs because she has decades to let it grow and recover from any dips. She's harnessing that long-term growth potential and compounding.
So same person has two goals, two totally appropriate but different strategies running side by side, saving for the near term, investing for the long haul.
That's the balance. And, we actually have a great quote from financial advisor Jane Doe that really sums this up.
Oh, yeah. What does she say?
She says, balancing saving and investing is absolutely key to long-term financial success. Secure your more immediate needs and goals through diligent saving, while simultaneously building wealth for the future by thoughtfully investing for the long term.
That nails it, doesn't it? Secure the short term, grow the long term.
It really reinforces that core idea.
Okay, that's solid advice. But even with a good plan, things can go wrong, right? Or there are challenges. What should we be aware of?
Absolutely. There are always headwinds. Inflation is a big one we keep coming back to for savers.
That erosion of purchasing power, the money you save just doesn't stretch as far later on.
Exactly. If your savings aren't earning at least as much as the inflation rate, you're effectively losing ground.
Okay. What about on the investing side?
Market volatility. We touched on it, but it bears repeating. Investment values will fluctuate. There will be down years, sometimes scary ones.
And that can be tough psychologically, can it? Watching your balance drop.
It really can, which leads directly to another challenge, behavioral biases.
Our own emotions getting in the way.
You got it. Fear making you sell low during a panic. Greed making you chase hot stocks after they've already run up. Our emotions can be our own worst enemy financially.
Making impulsive decisions instead of sticking to the plan.
Exactly. And finally, a potential challenge is simply a lack of financial literacy. Not understanding these basic concepts we're talking about today can make it really hard to make good, informed decisions.
Which is why we're doing this deep dive.
Precisely. Knowledge is power here.
So this raises an important question for you listening.
Right.
How do these challenges resonate with your current thinking? Are you worried about inflation? Does market volatility make you nervous? Thinking about that is valuable.
Definitely worth reflecting on. So as we start to wrap this up,
Let's pull it all together. What are the key takeaways?
I think the main thing is that both saving and investing are vital. You really need both for total financial well-being. They aren't competing ideas, they're partners.
Right. Saving is job number one for security. That immediate safety net, easy access for short-term needs, emergencies.
And investing is your engine for growth. It's how you potentially build substantial wealth over the long term, beat inflation, and reach those bigger, more distant goals, like retirement.
So ultimately, it's about finding your strategic balance, the right mix of saving and investing for your goals, your timeline, your comfort level with risk.
That's the recipe. Building that resilient financial foundation that works for you.
So what does this all mean? It means understanding these differences, these pros and cons, empowers you. It lets you take control, make informed choices, and build towards, well, greater security and prosperity.
And maybe leaves you with a question to ponder. Considering that interplay of inflation eroding savings, your personal time horizons for different goals, and your own risk tolerance, what specific tweaks or adjustments might you consider making to your current savings or investment approach right now?
That's a great question to reflect on. And for more in-depth insights, practical strategies on personal finance, investing, all the things we talked about today, be sure to explore the resources available at Side by Side.